Ever pondered over the difference between equity, options, and futures? These terms may seem complex, but they are the pillars of the financial market, and understanding them can help you navigate the stock market with greater ease and clarity. Firstly, consider equity. The word equity in the financial world refers to the ownership interest in a company. When you buy equity or shares in a company, essentially, you're buying a piece of that company. You become a shareholder, and as a shareholder, you have a claim on a part of the company's assets and earnings. For example, if a company issues 1 million shares and you own 10,000 of those shares, you own 1% of the company. Equity investment can be a long-term strategy, as you're essentially betting on the company's success over time. Now let's turn to options. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset, usually equity, at a specified price within a certain time frame. It's like holding a reservation. Imagine you're interested in a particular piece of land, but you're not quite ready to buy. You pay a small amount to hold the land until you make your decision. That's an option. There are two types of options: calls and puts. A call option gives you the right to buy, while a put option gives you the right to sell. Lastly, futures are similar to options in that they are contracts, but they differ significantly. A futures contract is an agreement to buy or sell an asset at a future date at a predetermined price. But unlike options, futures contracts obligate the buyer to purchase the asset and the seller to sell the asset at the agreed-upon price, regardless of the current market price at the expiration date. Think of it as a binding agreement, like when you book a vacation package months in advance at a set price, regardless of whether the rates go up or down in the meantime. Having explored each term, it's time to draw distinctions between equity, options, and futures. Equity is a straightforward transaction involving the purchase of a company's shares, giving the buyer ownership interest in the company. Options and futures, on the other hand, are derivative contracts that derive their value from an underlying asset, often equity. The key difference between options and futures lies in the obligation. Options give the right, but not the obligation, to buy or sell the underlying asset.
Nifty 50, often simply called Nifty, is a benchmark Indian stock market index that represents the weighted average of 50 of the largest Indian companies listed on the National Stock Exchange. It's a reflection of the health of the listed companies and, by extension, the Indian economy. The companies represented in the Nifty 50 span across 13 sectors of the Indian economy, from technology to pharmaceuticals, providing a comprehensive view of India's corporate landscape. This index offers a snapshot of the market's performance and sentiment at any given moment. Now let's shift our focus to Bank Nifty. This index is a bit more specialized. It represents the 12 most liquid and large capitalized banking stocks listed on the National Stock Exchange. It provides investors and market intermediaries with a benchmark that captures the capital market performance of Indian banking sector. So, how do these indices work? Indices like Nifty 50 and Bank Nifty operate on a free float market capitalization weighted methodology. This means the level of the index reflects the total market value of all the stocks in the index relative to a particular base period. The market capitalization of a company is determined by the stock price of the company times its outstanding shares. Now, onto futures and options. Futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and price. Options, on the other hand, give the buyer the right, but not the obligation, to buy or sell an asset at a set price on or before a certain date. In a nutshell, Nifty 50 and Bank Nifty are barometers of the Indian market's performance. They represent a variety of sectors and are calculated using a free float market capitalization weighted methodology. Futures and options associated with these indices offer ways for investors to hedge, speculate, and earn income. Remember, investing in the stock market always carries risk. It's important to do your research and consider your financial position and risk tolerance before diving into futures and options trading. Understanding Nifty 50 and Bank Nifty can provide valuable insights into the Indian market's overall health and trends. So, keep these indices in mind as you navigate the financial world. They just might provide the perspective you need to make informed decisions.